Today, we're diving into a topic that's making waves in the financial world: oil stocks you should consider buying before tensions in the Middle East escalate further. Specifically, we're talking about Iran's potential move to block the Strait of Hormuz, a critical choke point for global oil supply. This could send oil prices skyrocketing, and smart investors are already positioning themselves to profit. In this video, I'll explain what's happening, why it matters for the US stock market, and share 3 oil stocks you should look at right now. We'll keep it simple, professional, and packed with actionable info. So, grab a notepad, and let's get started. First, let's talk about why the Strait of Hormuz is such a big deal. This narrow waterway, located between Iran and Oman, is one of the world's most important oil choke points. About 20% of the world's oil supply, roughly 21 million barrels per day, flows through this strait. That's enough to power entire economies. Major oil producers like Saudi Arabia, Iraq, Kuwait, and the United Arab Emirates rely on this route to ship their crude to global markets, including the United States. Now, recent news has investors on edge. Iran's parliament has reportedly approved measures to potentially close the Strait of Hormuz as a response to geopolitical tensions, particularly with the US and Israel. This isn't just talk. Iran has threatened this before, and they have the military capability to disrupt shipping with mines, missiles, or naval forces. If the strait is blocked, even for a few weeks, oil prices could spike dramatically. Some analysts predict $120 to $130 per barrel or higher, up from the current range of about $80 to $90. Why does this matter for US investors? Higher oil prices mean bigger profits for oil companies, especially those in exploration, production, and refining. But it's not just about profits. Rising oil prices can also drive inflation, impacting everything from gas prices to groceries. That's why the stock market is paying close attention and why oil stocks are suddenly in the spotlight. So why focus on oil stocks? Simple. When oil prices rise, companies that produce, refine, or transport oil see their revenues and profits soar. US oil companies are especially attractive because they operate in a stable political environment, have advanced technology, and benefit from domestic shale production. Plus, many of these companies pay dividends, so you can earn income while waiting for stock prices to climb. But not all oil stocks are created equal. You want companies with strong balance sheets, low debt, and exposure to upstream activities. That's exploration and production, since they benefit most from higher crude prices. Today, I'm sharing 3 US oil stocks that stand out based on their fundamentals, market position, and potential upside in this scenario. Our first pick is ExxonMobil, ticker ExxonMobil, one of the world's largest integrated oil companies. This is a giant in the industry, with a market cap of over $500 billion in operations spanning exploration, production, refining, and chemicals. Why ExxonMobil? First, it's a leader in upstream production, with major projects in the Permian Basin, the heart of US shale oil. Higher oil prices directly boost their profits here. Second, Exxon has a rock-solid balance sheet with low debt, giving it flexibility to invest or return cash to shareholders. Third, it offers a juicy dividend yield of about 3.2%, paid consistently for over 40 years. That's income you can rely on. Recent performance? ExxonMobil is up about 15% year-to-date as of June 2025, but analysts see more upside if oil hits $100 or more. Their price target averages $130, compared to the current price around $115. Plus, Exxon's scale means it can weather volatility better than smaller players. If Iran disrupts the strait, ExxonMobil is a safe bet to capitalize on the price spike. Next up is Chevron, ticker Chevron, another oil supermajor with a market cap of about $300 billion. Like Exxon, Chevron is integrated, but it's known for its disciplined capital spending and strong cash flow. Here's why Chevron makes the list. First, it has significant exposure to the Permian Basin, where production costs are low, so higher oil prices translate to fat margins. Second, Chevron's global assets, like its LNG projects in Australia, diversify its revenue streams. Third, it offers a higher dividend yield than Exxon, around 4%, with 38 years of consecutive increases. That's a big draw for income investors. Analysts are bullish on Chevron, with a consensus price target of $175, up from its current $150. The stock's P/E ratio of 14 is reasonable, suggesting it's not overpriced. If the Strait of Hormuz faces disruptions, Chevron's upstream profits could surge, and its refining business would benefit from wider crack spreads. That's the profit margin on gasoline and diesel. Our third pick is Occidental Petroleum, ticker OXY, a smaller but aggressive player focused on U.S. shale. With a market cap of about $50 billion, OXY is more nimble than the super majors, offering higher growth potential. Why Occidental? First, it's a pure-play upstream company, meaning its profits are highly sensitive to oil prices. If crude jumps to $120, OXY's earnings could skyrocket. Second, it's a favorite of Warren Buffett. Berkshire Hathaway owns over 25% of the company, a huge vote of confidence. Third, Occidental has been paying down debt from its 2019 Anadarko acquisition, strengthening its balance sheet. OXY stock is trading around $60, with analyst targets near $80, implying 30% upside. Its dividend yield is lower at 1.5%, but the real appeal is capital appreciation. If Iran blocks the strait, smaller producers like OXY could see outsized gains due to their leverage to oil prices. Now that we've covered our top picks, let's talk strategy. Investing in oil stocks during geopolitical tensions can be profitable, but it's not without risks. Here's how to approach it. Diversify. Don't put all your money in one stock. Consider a mix of ExxonMobil for stability, Chevron for dividends, and Occidental for growth. Watch the news. Keep an eye on Iran-related headlines and oil price movements. X is a great place to gauge market sentiment, but verify with reputable sources like Bloomberg or Reuters. Set stop losses. Oil stocks can be volatile. Use stop-loss orders to protect your capital if prices drop unexpectedly. Think long-term. Even if the strait isn't blocked, global oil demand is growing, and supply remains constrained. These stocks could benefit beyond this event. Consider ETFs. If picking stocks feels overwhelming, look at ETFs like the Energy Select Sector SPDR Fund, which holds Exxon, Chevron, and others. One last tip: timing matters. If you're convinced a strait closure is imminent, act sooner than later. But always invest what you can afford to lose and do your own research. Before we wrap up, let's talk risks. Geopolitical events are unpredictable. If Iran backs down or negotiations ease tensions, oil prices might not spike, and these stocks could pull back. Also, a broader market sell-off, say, due to recession fears, could drag oil stocks down, even if crude rises. Finally, the shift to renewables could cap long-term oil demand, though that's a distant concern for now. And there you have it, 3 oil stocks to consider before Iran potentially blocks the Strait of Hormuz: ExxonMobil, Chevron, and Occidental Petroleum. These companies are well-positioned to profit if oil prices surge, and they offer a mix of stability, income, and growth. What do you think? Are you bullish on oil stocks, or are you waiting for more clarity? Drop your thoughts in the comments below. I love hearing from you. Thanks for watching, and I'll see you in the next one.